Hi everybody. This video is for the topic uh, of cost volume profit relationship. Okay, the CVP analysis or CVP relationship is a topic about the relationship between cost, volume or quantity of production and profit to be made by a business. In this topic, you will learn about uh, what happened to the quantity of production and profit if there is a change in cost. Remember, before this, you have learned that cost can be divided into variable cost and fixed cost. So that knowledge will be useful in this topic. There are several important things that you have to understand in this topic. The first one is see here, there is a new format of income statement. Okay, this format of income statement is called contribution income statement. Okay, the format is like in this slide. The first thing that you have to show in this income statement is the sales revenue, and then minus variable costs or expenses. You will get an item called contribution margin, and then you have to minus the fixed cost or fixed expenses. Then you will get the net profit. Okay, this is the format of income statement that typically used in management accounting. This format is used in management accounting because it is clear to the user of the management accounting, which is the manager. It is clear for them to see the variable cost and the fixed cost in this income statement. If you are a manager, when it is very important for you to know how much is the variable cost and fixed cost. It allows you to control the cost, to try to minimize the cost and try to it allows you to think about how to manipulate the cost. Before this, when you learn about financial accounting, you have seen another format of income statement. In financial accounting, you have learned that to prepare an income statement, the format is like this: sales revenue minus cost of goods sold, you get gross profit, and then minus expenses, you get the net profit. That is the format that you have used in financial accounting. In management accounting, we most of the time use this contribution format income statement. Okay, that is the first important thing that you know, that you have to know in this topic. Okay, the second thing is you have to know about the term contribution margin here. Okay, you have to memorize this. Contribution margin, see the blue box. Contribution margin is the amount remaining from sales revenue after variable expenses have been deducted. So contribution margin means or equal to sales revenue or revenue minus the variable cost. So if there is a question asks you to calculate contribution margin, then the answer is revenue minus variable cost. Okay, there are two types of contribution margin: total contribution margin and unit contribution margin. In this sample income statement, you can see there the total contribution margin is 250,000 minus 150,000. The total contribution margin is 100,000. And at the same time, the unit contribution margin is 500 minus 300, which is equal to 200. That is 200. The 200 is the unit contribution margin. Okay, in this income statement, the business is called Win Bicycle Company, and then the business obviously sells bicycle. So the per unit data is the price of a bicycle sold by the business is $500. So 1 unit bicycle is $500. Here the business sold 500 bikes. So 500 times 500, the total sales is 250,000. The unit cost to produce the bicycle in this example is $300. So if the unit variable cost is $300, the total variable cost is 150,000, which is $300 times 500 bicycle. So remember, you have to know about contribution margin, and you have to aware that there are two types of contribution margin: total contribution margin and unit contribution margin. There are some explanation about the contribution margin here, but I want to show you the most important thing. Okay, this is the most important thing about the contribution margin. You see here, if a business contribution margin equal to the business fixed cost, then the business will get zero profit. See here, in this sample income statement, the data is in the middle. Here, the data here, when the contribution margin equal to the fixed expenses or fixed cost, 80,000, and the contribution margin is 80,000 and the fixed cost is 80,000, then the profit for this business is zero. And then see the data in the right side. If a business contribution margin is higher than the fixed cost, then the business is making profit. Here in the left side of the data in the left side is when the contribution margin, the total contribution margin is less than the fixed cost of the business, then the business is making loss. So it shows that contribution margin is very important. If you have a business, you have to control the contribution margin. The higher the contribution margin, we can say that the higher the contribution margin, the better for your business, because you can make profit, you will make profit when the contribution margin is higher than the fixed cost. Okay, that is the second thing. Okay, this is the relationship between the revenue and cost. Okay. This is another thing. This is number 3. Another important thing that you have to know in this topic. Okay, the thing is called contribution margin ratio. Okay, you have to memorize this. The contribution margin ratio, you have to memorize this formula. The CM ratio or contribution margin ratio is equal to total contribution margin divided by total sales. So contribution margin ratio, actually there are two methods that you can use to calculate the contribution margin ratio. First, using this formula. Using this formula, you use the total data. So CM ratio equal to total contribution margin divided by the total sales. So we use the Wind Bicycle Company income statement. You can see in the slide, in the second slide, I think. In the second slide, you can see that the Wind Bicycle, the total contribution margin for this business is 80,000, and then the total sales for the business is 200,000. So the CM ratio for this bicycle company is 40%. So another way to calculate the CM ratio is using the unit data. If you use the unit data, then the formula to calculate the CM ratio is CM ratio equal to unit contribution margin divided by unit selling price. For this bicycle company, if you want to calculate the CM ratio using unit data, then the calculation is 200. The unit contribution margin is 200 divided by the unit selling price is 500, and the answer is 40%. Same. So remember this. If somebody asks you to calculate contribution margin ratio, always remember there are two ways to calculate the contribution margin ratio. The first way is to use the total data, explained in the previous slide. And the second way to calculate the contribution margin ratio is using the unit data here. Unit contribution margin divided by unit selling price. Okay. The contribution margin ratio actually explains about it explains about how much contribution margin increase when there is an increase in $1 of sales. So here, for example here, if the CM ratio is 40%, then for every $1 increase in sales, there will be an increase of contribution margin by 40 cents or 40%. Okay, this is a sample question related to the calculation of CM ratio. So there is a business called Coffee Clutch, and then the average selling price this business sells coffee. So the average selling price of a cup of coffee is $1.49, and the average variable expense per cup is 36 cents. The average fixed expense per month is 1,300. 2,100 cups are sold each month on average. So the question is, what is the CM ratio for Coffee Clutch? So remember, there are two ways to calculate the CM ratio. So here, you have to use the second way, which is using the unit data. So CM ratio equal to unit contribution margin divided by unit selling price. So see the unit contribution margin is $1.49 minus 36 cents divided by the unit selling price $1.49. So the answer is 0.758 or 75.8%. Okay, this is another way or another thing that you have to know and aware related to this topic about CVP analysis. You have to know that your knowledge about CVP relationship can be used to make simple business decision. Okay, this is an example. See here. Wind Bicycle Company is currently selling 500 bikes per month. The company's sales manager believes that an increase of 10,000 in the monthly advertising budget will increase bike sales to 550 units. Should we authorize the requested increase in the advertising budget? So the scenario is like this. The business is currently selling 500 bikes per month. The sales manager believes or suggests that if the business increase the advertising budget by 10,000, then the bike sales will increase to 550 units. So this is a suggestion made by the sales manager. So if you want to decide whether to agree or not to agree with this suggestion, then you can use the knowledge about CVP analysis to help you to make the decision. So the way to make the decision is like this. You have to compare the profit before the suggestion and after the suggestion. Okay, see here. So before the suggestion, you see current sales data. Before the suggestion, the company sells 500 bikes. So 500 bikes, the sales revenue is 250,000, variable cost is 150,000, contribution margin 100,000, fixed cost 80,000, and the business is making 20,000 profit. Okay, and then the data in the right side here is the data related to the suggestion made by the sales manager. The sales manager said if the company can increase advertising expense by 10,000, then the company can increase the sales of the bicycle to 540 units. So what will happen? So see here, if the for the sales manager suggestion, the sales is 450 units, so the sales revenue is 270,000. How to get the 270,000? 540 units times $500 per bikes or per bicycle. And then when the bicycle units increase to 540, the variable cost will also increase by the variable cost will also increase. The variable cost per unit is $300 per bicycle, so $300 times 540 units, the variable cost is 160,000. So the new contribution margin is 108,000. the fixed expenses has increased because the sales manager suggested that the company should increase the advertising expense by 10,000. So the new fixed expense or fixed cost is 90,000. So the profit is only 18,000. So here you can see that profit before the suggestion is higher than the profit after the suggestion. So if you are the owner of the business, the sales manager suggestion is good or not? The sales manager suggestion is not good because the sales manager suggestion is not good or cannot be accepted because the profit after the suggestion is lower than the profit before the suggestion. So this is the way to make simple decision using knowledge about CVP relationship. You compare the profit before the suggestion and profit after the suggestion, and you can decide whether the suggestion is a good suggestion or not. Okay, thank you very much. This is the first half lecture for this topic. You can communicate with me in the comment section.